for trades. But man, I gotta tell you, when the Bernanke starts running that yapper,
what I'm trying to say here is a very important concept, and it's an extremely difficult concept for some traders. You can manage risk, but you can't manage
you make
return.
Some money trading London.
Now the average trader says, "Well, wait a minute, I'm in this to make a profit." What do you mean I can't manage return? Well, you can't. You don't know where the market's going to go. If we look at most traders, they end up losing their capital. I used to have a discount futures trading firm, and most people start off and they lose their capital fairly quickly, and a lot of them never get it back. If you start by looking at managing risk, that is something that you can control, and we will talk about that as we go through the presentation today. Managing risk has to do with trade location, and we'll define trade location in a couple of different ways. The trade location is the best risk control tool you have. And if you only engage in trades with good trade location, you will keep yourself from over trading.
Fabulous.
That statement came from a client that I don't do much individual mentoring, but I was mentoring an individual client out on Cape Cod. And we were talking about trade location. He was a constant, over trader. And of course those little losses add up very quickly. You got the spread between the bid and the ask. You got the commissions in there, and overtrading generally means you're engaging in a lot of emotional trades. But he said to me, Jim, I think I figured out what you're saying. If I can only put a trade on if I have good trade location, he said that's going to keep me from overtrading, and I think that's exactly right. Let's see if we can give this a little more meaning, and let's go to the next slide.
Okay.
And the next slide, it says, what defines good trade location? Good trade location only occurs when you know before placing the trade where to place a structural stop. Now that leads to another thing, and that means that I have to define structure. Some people will be more comfortable with structure than others. But for example, this morning, hold on. This morning I said one of the references was the overnight low. The overnight low is one of the structural references that I'm looking at this morning. So if I can stay below the overnight low, then I'm below that piece of structure. If I can't stay below the overnight low, and the market fails and it comes back into yesterday's or into the overnight range, now I've violated the structure. So if I'm short this morning, and go with the gap, if I'm short, and I monitor for continuation. Monitor for continuation means that I want to get below the overnight low, and I want to remain below the overnight low. Mm-hmm. So now, if I was short, and the market has moved down below the overnight low, I would drag my stop so that it was someplace back in the overnight range. Okay, let's try and define structure via our examples.
Okay.
What you're looking at on the next slide, this is the S&P's morning update of 227, and this is something that we put out in the morning blog, and there's for clients. Non-clients can get it on a delayed basis. But what you're looking at right here is I defined the range on the top. You'll see we had a range, a high on 226. You will see the overnight range, which is in pink. You will see that high was just a little bit shy of the high from the pit session on the 28th. And you will see on 225, when the market was breaking, that's the first little area I had some double prints. So I came across that, and I'm looking at that to say, this is where the market was contained. This is where it was contained. It was contained on the overnight rally. It was contained there on the previous day. So what I'm looking for in trading is I'm looking for some sign of change. Trading is about change. So if in fact you can't get back up above that level at the 1497.50 level, if you can't get above there, then the market's going to maintain the same direction that it had coming into the day. If you can get back above that level, now that's a sign of change, and change usually brings in additional activity in the direction that the change occurred. For example, we always talk about auction market theory. And one of the examples I'll use, if you go to an art auction, and we're just using a simple auction that only goes in one direction. But if you go to that auction, the expected response is that as prices go higher, that the bids drop away. Higher prices should start to cut off the activity. If in fact it's just the opposite, that higher prices bring in more activity, then you've got a very strong auction. For example, if an auctioneer was trying to get an auction started, let's say he was trying to get a piece of artwork and get the auction started at $100,000. If nobody will lift the bid at $100,000, well, what does he have to do? He has to quickly drop his bid to get the activity going. So he may drop it to $95,000. And at $95,000, all of a sudden the bidding gets underway. Once the bidding is underway, it may go very quickly back through $100,000, where no one would lift the bid earlier in the day. So all of a sudden now you're at 100,000, 105, etc. So in most cases, as the auction will get started, and then the auction goes higher, and it starts to slow. When it slows, you'll hear the auctioneer put fillers in. When it's early on and it's moving, he'll say, I have 100, I have 101 and a half, 102, 102 and a half and 3/4. Then when the auction is slowing, you'll start to hear him put fillers in. I have 102 and a quarter for this beautiful blah, 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 blah. And he goes on. And that's a sign that the auction is slowing. And at that point in time, that's an indication. Tempo is slowing and the auction is coming to a close. Now,
so Jim, would you say that the auctioneer's value areas are starting to overlap?
Yes. Yeah. Yeah, that's exactly right. Well, any market, if you come back, the goal of any market or any business is to find a place where two-sided trade can occur. Nobody makes any real money in any business unless you have a place where two-sided trade can take place. We have all kind of history of businesses having great ideas, but nobody's there to buy them. Mm-hmm. So it'll be the greatest idea in the world, but if there's not two-sided trade, the idea is it's not going to work. It doesn't make any difference how good or how valuable it was. And that's the same thing in the market. The market is a business. And the similarities of business, we're talking about cash flow, we're talking about profit, we're talking about taxes, we're talking about inventory. So all of the things that you have in any business, you have when you are trading futures. You have cash flow, you have taxes, you have inventory, you buy and sell that inventory. Hopefully you buy and sell it at a profit. So it is a form of business. Well, it's also when these markets are looking for places where two-sided trade can take place. Now, the example I was going to, let's say that the standard auction, as the auction goes higher, you start to hear the auctioneer put filler in. That tells you that the auction is slowing. But there may be other times where you hear the auctioneer say, new bidder. If you hear the auctioneer say new bidder, that tells you that higher prices are not cutting off activity, but rather higher prices are bringing in more activity. Mm-hmm. When that happens, then the market is really strong the auction has really gotten some legs, and we're probably going substantially higher before this auction is over.
Hey, Jim,
Yes.
can I ask you a quick question? That's
Sure.
an awesome example. Number one, what you said about, GM car manufacturers selling to dealerships, and then the whole auction, when it's fast and frenzied, the auctioneer has a lot to say, but when it slows down, there's fillers. What are other examples of fillers that we as traders can look at? Because obviously we don't have an auctioneer telling us, you know what I mean, like, bid 101, then 101 half, and then all of a sudden, look at this beautiful painting, because things are starting to slow down. Like, what are some other things that we can look for to let us know that that auction is slowing down?
If you were trading the S&Ps yesterday afternoon,
Mm-hmm.
even though the market finally got to a previous high,
Right.
it was just the tempo was exceptionally slow, the volume was low, and it was just agony going up there.
Yeah.
And
like
so that
there-
auction,
no new bidders
the
came
auction
in.
was going, but it was really, really struggling, and the bids were really drying up.
Okay.
Okay.
Okay. Now, so we have this example in front of us. So I have the upper containment area, and then you can see down on the bottom, I have another line which is the containment on the downside. So what I had written that the market was between 1497.50 and 1418.50 was where the market was contained. So what I wanted to do is, I want to see if I'm outside of that range, my opportunity will probably be pretty big. If I'm within that range, then I will probably have smaller opportunities. I'll do smaller trades. Okay? Let's move over to the next slide.
Okay. Give us 1 second, Jim.
Okay?
There's a slight delay in the video. So like right now we're already on the next slide, but it'll be about 10 seconds before everybody sees it. Just to confirm with you, it should be the one that says morning update 227 comments, right?
Correct.
All right. Let me just see if it's being viewed by everyone. Yeah, it'll take just 1 second. It should be flipping shortly. Okay, there we go. All right.
Okay, if anybody, before we go to this slide, if anybody has their market up looking at the S&Ps, you will see that it's coming up almost exactly to the overnight low. It came up and it traded within a tick of the overnight low. So that's my reference, remains the overnight low. If I get back within that overnight low, then the pretty good odds that I'm going to start the auction a little bit higher. If it holds and it doesn't get back into that level, then you get another wing to the downside. All right, back to the slide. This is what I wrote on the morning of the 27th. Following Monday's break, the market has balanced between, and there's the levels I gave before, 1481 level and 1498. I used 1497, but this is to put it in a package. Any meaningful directional auction will occur outside of this range. Treat this as a wide balanced range. Balanced trading rules apply. So let me cover the balanced trading rules. If, in fact, you start off and you're near the upper end of the balance and you don't break out to the upside, then more than likely you will start to rotate down towards the lower end of the balance. If you look above the balance, there's usually two things that happen. One, you look above the balance and fail. In other words, you got above the balance, the market did its investigation, it auctioned above there, and the reason the market auctions is to investigate and discover where the fairest price is and where business should be taking place. So you look above the auction and it fails. Now you failed to break out of balance. Once again, the destination trade or the potential comes to the opposite end of balance. Does it have to happen? No, of course not. But it is something that we keep in mind and some idea of where the market may try to go. The other thing that happens, you look above the balance and you accelerate in the direction of the breakout from the balance. So you usually have three things when you're at the extreme of a balanced trading range. you remain in balance. If you remain in balance, you generally then start to rotate back towards the opposite end. Second, you look above the balance and fail. Again, you start to rotate back towards the opposite end. Or thirdly, you look above the balance and go. So in here, I wrote a downside breakout would target the lower gap that would be filled, and there's a gap down there, 1468.90. Then I said an upside breakout would target the 1500 level initially, which we know has been something that people had watched. And then this would be followed by the next would be 1505, and then it has to be 10. I didn't put those on. So when I do this, what I'm trying to do is when I come into the morning, I want to have some idea of what I want to do and how I want to act under different market perspectives. The most dangerous trader is a trader that comes in and has only one single idea. They want to kill the market or they want to really buy the market. Trading is about flexibility. And it's one thing to have a bias, but it's another thing to be able to overcome that bias if that's not what the market is communicating to you. So when I come in the morning, at a minimum, I always have 3 scenarios that I want to look at. And in this case, because I'm at the upper extreme of balance, scenario 1 would be remain in balance. Scenario 2 would be look above the balance and fail. Scenario 3 would be look above the balance and accelerate to the upside. So that's where my mindset is. That's what I'm always trying to prepare myself for. You'll see at the end we'll do a promotion here for a seminar that we're going to do in Chicago at the end of April. But during that seminar, you'll find that that's what we try and get people prepared for every day and build in that flexibility. Okay, Peter, let's go to the next slide.
Okay.
Let me know when we're ready.
All right. I'll tell you in 1 second.
And while that is happening, people are between the overnight range.
Right.
That's where
Just
the market
now we
is
had a look above the 1503.50, which was that double bottom at around 8 a.m. Eastern. There, that low was actually, 1503.25. And so right now we kind of had a look above and not look above balance, as you say, but, we looked above that overnight low, and so far we're kind of right at it.
Yeah. And the market, it's a very mechanical market. You see the low this morning, I think it was, if I'm reading this right, was 1499.25.
99.5, I believe, or 99.5. Yeah, 14.99.5
Okay.
was the low.
So again, like I said, it's all short-term traders. They went down to exactly to the 1500 level.
Right.
And there's no long-term money. It's been more games than playing in here. But continue to keep in mind that there's a lot of shorts in this market, so you got to be very cautious. Okay, let's go back to the slide that is in front of us.
It's called Can You Imagine This, right?
So much about trading is your imagination. If you can't imagine what a market could do, you very often will end up either missing, in this case, the market broke to the upside. If you can't imagine what the market will do, you will either miss the trade, or what's even worse, you will fade the trade. Fading means go against. And there's nothing that feels worse than that. And then you get caught with the deer in the headlights and you sit there all day and, it just kind of tears you apart. But if you get some idea here, when you're looking at this, it's just the same slide to an extent that we looked at in the prior slide. But I had marked the containment areas coming into the morning. And you see that the market has a high confidence opening. You have basically an opening drive, very high confidence opening. It goes up through the balance area. Now, if you were trading this market, and I actually had a client, we were having breakfast, and I usually don't do that, but I had a client, we were out at breakfast, we had the laptop set up, the market broke, and I said, what I think they'll do here, they'll automatically sell them at the 1500 level, It tagged, I think it went one tick above 1,500. They sold it immediately. Then, and this is very important, the breakout level was 1497.50. That was the high. Once you have an upside breakout, that breakout level becomes support. The market went to 1,500, came back down, and I only saw it trade one tick below 1497.50. And that's in the B period, in the initial period that we're looking at. Mm-hmm. And at that point in time, my client, who's really kind of a neat guy, he's been an emergency room doctor for 14 years. He's got great instincts. He hasn't been trained that long, but he's got great instincts. And he said, is this the buy or a rebuy? If you'd sold it up at the 1,500 level. I said absolutely. And so that's one of the questions I always get that frustrates people, and they want to know, well, where do I get in? Where do I put my stop? And it's very frustrating. And of course, my partner always tells me that she's very cautious. Sometimes when I hear that question, I give kind of a sharp answer, and I say, I don't know exactly where you get in. I don't know exactly where you get out, and that's true. So much of it has to be just an understanding of the market. But let's talk about a specific. In this case, you had two places to buy this market. The one, when it came back down and tested at the 1497.50 level, and I think it only traded below that level for one tick. The second would be in the test in C period, where it came down and it could not get into the back below the support at the 1497.50. And the question becomes, where do I put my stop? Well, I put a line up there, and I don't know the exact price, but I'm going to put my stop someplace back below the support level. So there was two places that had bought that morning on the first test down to 1497.50, and the second opportunity would have been to the B when the C period came down and couldn't get down there. Now, when you look at that, you can put a trade on, and you can have a pretty close stop because the structure, we are defining 1497.50 as the structural reference. When I say, use structure to guide your trading. And what you want to know is that where you put your trade on, that's your risk level, because you can manage risk, but you can't manage return. You want to put down there so that you can get onto the trade and you can put a stop based on structure, not based on some price you pull out of the air, or I'm willing to lose a point or 2 points or whatever it is, but based on structure. So when I look at that, I can sit there and say, okay, that's a reasonable trade because I can put a pretty close stop. That stop is based on structure. And now I have a way to control my risk. I may not win, but I'm not going to take a huge loss on the trade. Now I came back and it's titled, Can You Imagine This? Well, I can't show everything on this, but what you will find is the days coming down, when this market broke to the downside, there was a substantial break and there were substantial anomalies. Anomalies are little things on the profile where it doesn't look like it's symmetric. And when I looked, the market was too thin. When the market came down, it was too thin. It was too elongated. This bit's a little difficult for people to appreciate. If a market is too elongated, that is usually a sign of either short covering or long liquidation. And it's very often not going to last a long time. A healthier market, and it has more symmetry. It will go up, for example, then it will settle a little bit, then it will go up again, then it will settle a little bit, it will go up again. It's kind of a wave-like market, and maybe the profile gets, 4 and 5 wide in a few places. You've just got more of a reasonable pattern. When that happens, it's usually a sign that you've got some, longer-term money underneath the market or above the market, depending on which way it's going. When it goes like this market, that's usually a sign that you got the shorts caught, and it's just get me out at any place, any price, combined with the short-term momentum traders that all they're trying to do is jump on board and press prices higher and higher and higher. And you'll see at the bottom, it says what occurred before has a lot to say about the odds going forward. Anybody that's spent time with me or been to a seminar, webinar, has heard that from me many times. And the story behind it, it took place years ago before the tax laws changed. Doctors, lawyers, business people, they love to go to places like Las Vegas and, have a big outing. And then in order to write it off for tax purposes, they'd have a short seminar in the evening.
Right.
And of course, if you're doing the speaking, that is not a very favorable time because they've been playing golf, they've been drinking, and nobody really cares to listen to you very much. It's just that they sign in the sheet, they want to get on the thing, so they've got a tax record for it. So I was doing this in Las Vegas, and that left me to that. What do I do that's interesting, keeps their attention? Well, what I did is I talked about trading and related it to blackjack. Years ago, I did some card counting, but I had clients that were the top card counters in the country. Sheen Kassouf, Ned and Sheen Kassouf, I got one of the names wrong. Kassouf was the second one. But anyhow, when you're counting cards, what had happened before has a lot to say with the outcome going forward. So now, when I looked at that, the way the market broke on the downside had a lot to do to give my imagination. It was so thin, it told me that I had a pretty good opportunity that the market, if it got started on the upside, would squeeze a lot of shorts. Now, Peter, if we can you put up a live market for a second?
Absolutely. Sure thing.
Put up a live market
Futures are
on
just
the
breaking
S&P
out. Futures just broke to new
I'm going to take
highs.
this point we just talked about.
Yep.
I'm going to make it a little real.
Okay.
Yeah, so I've got the
Let me know when they
futures
can
up,
see it.
Jim.
Yeah, they should be able to see it. Hold on one second.
Yeah, I've got the live ESs up here, Jim. We just hit new highs. We had some numbers come out, ISM index, and the market just shot to new highs.
Okay.
Right.
But here, let's say this. Remember, before this ever happened, we put up the slide. I showed the 45-degree line from yesterday.
Okay.
Yep.
And
The
I
big
said the
number
market
today
was
was
more than likely short yesterday.
ISM
The
manufacturing.
overnight got it too short. So
It follows
when
the
I was
trend
looking
this
at this
week.
market
Most
swing, then I
of the
had
big
a
news
reference. I said, once we
has
got
come
below
in
the
higher
overnight low,
than forecast.
understand there's a lot of traders that all they do they were just blindly, jumping onto the short side this morning. I wouldn't have gone short, and what I'm sitting there saying, and you heard me talk about, I thought the market was too short. Thought it was too short from yesterday, the 45-degree line, and I also looked at the overnight inventory and was short. So now I'm prepared. What has occurred before has a lot to do about the odds going forward. So now, if I wasn't doing this presentation, and we never know if it'll happen in fact, but more than likely, I'm long this market, and I'm long this market, particularly when it came back into the overnight range. There's nothing happening right now in that market that you didn't hear us talk about before it happened. So much of trading is understanding what occurred before has a lot to say about the odds going forward. So it has a lot to say about the odds of continuing lower. It also has a lot to say about the potential for a rally. So we don't know what's going to take place now. We did not get into yesterday's range. We got back into the overnight range, but we didn't get into yesterday. We did not fill the gap. And so that gap becomes a major focus. We're only a couple ticks short, but that gap becomes a major focus.
For later
right,
today,
so,
you're saying?
Pardon?
For later today and going forward.
Yes, yeah, that gap. Now, see, what I would have done, had I been long, and of course you never know for sure, but more than likely, I would have taken my short-term trade and I would have exited just prior to the gap.
Knowing that the
People say,
gap
well,
is usually resistance. That makes perfect sense.
absolutely. Well, I'm looking for it's the cherry pick. It's the easier trade. Now that doesn't mean that I won't rebuy later, but the first time up there, there's a very good odds that there will be automatic selling. Markets are very visual. People can see that gap. Every week we all talked about it, and markets tend to go to very visual levels. The gap was visual. Yesterday the market went to a previous high. That's a very visual reference point. And you know, markets aren't nearly as mathematical as they are visual.
Do you think, Jim,
a lot of
it's
people
also,
can't do the math.
I'm sorry, do you think almost it's like a self-fulfilling prophecy? You know what I mean? Like, as you say, visual, we went to the high from 2 days ago, stopped perfectly, and then, you know, the market sold off. Is that kind of what you're saying?
Absolutely.
Yeah.
Peter, you're right on the money. Because,
Good
I mean,
job, Peter.
you know, we all want security. And what we can see, we feel pretty comfortable about.
Right.
Now, Jim,
Now-
I'm sorry, this is Brad. One quick question. Now, when you say the gap and yesterday's range, like yesterday's low is 1509 quarter. So what you were saying was if you were long, you would be selling right at the bottom of yesterday's range. Is that what you mean when you say gap, or are you
Right.
talking all the way
Yeah,
back to
yeah,
fairest price?
That is exactly. And incidentally, I take a gap. A gap to me is only from yesterday's low.
Okay.
It is not from yesterday's settle. Most people look at gaps differently than I do.
Okay.
I look at them only relative to the previous day's high or low.
Perfect. Thank you. And
Okay.
then so in this scenario, you said if you were long, you'd be selling, but then what would make you buy again if you broke back up into that range a second time?
No, on a pullback, I might buy a pullback.
Okay.
The ideal place the market goes to half back. And a lot of times, once these things get underway, it's rare that they don't keep going. This may be the case today, but you got a pretty good buying tail down there this morning. So you know, generally what I would do, I take the fast profit. You know, if I got in a good place, I take the fast profit, and at that point in time, I would look for a place to rebuy it unless it really went lower.
Right.
See, one of the references too, I think the opening this morning looks to me like it was 1506.50.
1506.75 was the open.
Okay, 1506.75.
Yep.
The open is also a reference that short-term traders need to be aware of.
Okay.
Any short-term professional trader has been around for any length of time. They know the opening, they know the previous day's high and low, they know what half back is for the day as well as for any particular period. Those are just things that are automatic to them.
Mm-hmm.
Okay, so we'll watch that, but let's go back to the scheduled presentation
Okay.
in here.
Okay.
In to what we talked about this morning, the need for preparation before you come in for the day, and a better need for understanding of what the conditions are that you're working with. Most people don't do that. They get the market trading, they get so locked into price, they totally lost in just a sea of price movement going back and forth, and they don't understand the bigger picture of what's going on, and that's where you get chopped up in the market.
Okay.
We talked about the important things coming in. Those are the things that are happening.
Start it.
Okay.
Just start it.
Now we can go to the next slide. Okay.
Okay.
Okay, give us 1 second. While we're going to the next slide, I just want things is one is that, you know, when you have a very large gap, even if you don't follow market profile, you have to understand that the overnight inventory is short. And there's been already a large move been made overnight. And that's why people who follow my stuff know that, you know, for years I've always said be very cautious on the large gap of assuming that you can go in the direction with it right away, because very often you'll get this sort of violent move to the upside. Today we saw this specifically on the ISM number, and a lot of traders, I think, falsely focus on what that news is and thinking that, well, it was the news that made that happen. But the reality is that the news is simply a catalyst, which then spurred a market that was already overly short from day time frame traders to quickly cover their shorts. And would you agree with that, Jim?
Yes, that's perfect, Peter. And I love it because that's not what you hear from the commentators on the radio.
Exactly. They're always going to tell you, well, the ISM came out better than expected and the market rallied and whatever. Yes, that is perhaps a catalyst for everybody hitting the button really quickly, but the violence of the up move and how quickly it occurs and how it kind of reverses course on everybody with a big surprise and shock and awe is due to the underlying structure of the market and the profile that had already been building from the prior day or the prior day before that or whatever. So that's why it's really important when Jim says, look at what, what happened before often sets the tone for what's going to happen that day or later on.
Peter, perfectly said.
Thank you. Beautiful. All right. So
people always want to attribute to something that's easier to understand. And it's easier to understand a news announcement than it is that the market was too short.
That's correct. Exactly.
All right.
So early trade location, Jim, right? Isn't that the next slide?
Yes, it is.
All right. It's all you.
Okay. Now, this slide is up there because this is what happened early yesterday. And once again, you can see that I had an early containment letter zone, and this is taken from our pre-market blog, or blog in the morning. And I had the containment at 15.19.25 and 15.14.25. I have that as the two containment levels in there. Now, so that was my balance, and if you'll notice, from 12.27, it was a double distribution trend day to the upside. I treat the upper distribution on this trend day as a separate day or auction. So I treat it as a separate day, and I want to know if I am in balance or out of balance relative to that day. Now, what happened yesterday, you see the market opened down there near the bottom, and I don't remember which order it went. I don't know if it went down first or up first, but what you'll see is on the first period, the market gave you two places for a trade. It looked both above the containment range and below the containment range, or the short-term balance. Remember the three rules we talked about earlier. Stay within balance, look above the balance and fail, look above the balance and accelerate. Look below the balance and fail, look below the balance and accelerate. You had two short-term trades in the first period yesterday when the market looked both above and below and failed. When that happens, so the first, let's say it failed in on the low first, and I don't remember what happened, but let's say it failed on the low first, the destination trade becomes the opposite extreme. When it fails on the high, the destination trade becomes the opposite extreme. Everything works according to what we talked about prior to it happening this morning. So now what happens to too many traders? Too many traders place trades. Remember I said structural. How do you control risk? You control risk through understanding structure, placing your stops close to structure. So if you look at when it looked above the high, and it comes back in, once it comes back in, you put your stop up there. You don't want that taken out. You look down below and fails, there's your buy, and you put your stop back down in that tail. There were I see two trades early on in the morning, and when you do that, you have structure to lean on. You have a better understanding. Where I would be willing to bet that an awful lot of people listening to today place trades in the center or in the fatter part of that containment range and probably got chopped up. Most people overtrade. Again, one of the statements I made, the best risk control element is structure and trade location. So we're trade location on the high. It's when you come back in. So you have a location. You have a structural place to put a stop, and those were the only two good places that I saw for trades in the first half hour. Too many people get too emotional. They're so afraid that they're going to miss the early trade and miss the trade for the day, and they get chopped up. There were 2 trades there. If you did more than that, I don't see it. So I had structure. I had places to put my stock. I had done my homework. I had a containment area. And again, this was all stuff that I published prior to the market opening. So there's no secrets. There's no cherry picking going back later and say, you know, there it is. So, but I understand structure, understand where you place your stocks, understand where you get in the trade. I don't know exactly, but you have reasons to do those trades. You have ways to monitor those trades. For example, if I bought them early, I'm going to, as a short-term trader, that's all I'm talking about. I'm assuming most of the people here are short-term traders. If I bought them early, as it gets up near that high, at that point in time, I'm going to come out of that trade. I'm going to come out and take my profits. If I sold them early, I'm going to take my profit as it comes down near the lower end. I'm not going to wishful think. I'm not going to wishful think. I'm going to take the trade because I define myself as a short-term trader. I'm going to take the trade. I'll decide if I want to do another trade later on. It's getting that discipline. It's getting that control and knowing what you want to do and having a reason to do it and controlling your environment. Okay, let's go to the next slide.
All right. Give it 1 second to
Certainly.
populate.
A different way to look at trade location, Jim?
Right?
Yes.
Okay.
Yes.
I'll give it a second. I'll tell you when it pops up on mine. Then I'll assume that everybody else can see it at the same time. Meanwhile, guys, we have, while we're waiting for that to come up, we've got ES moving up to 1508.25. So above that, that overnight low has been taken, and we moved up into yesterday's, closer into yesterday's range, I guess.
We went into it. Yep.
Yeah, 1509.2. Breadth is currently 2.77 to 1 negative on the NYSE, 1.65 to 1 negative on the NASDAQ. Watch your ADs, guys. The advanced decline line may be breaking over the high, which is still a firmly negative number, but that would be somewhat of a tell if you see NYSE AD move over a high of minus 737. And tick distribution is neutral with a high tick of 750 on the upside on the NYSE, so I'm going to be watching that level as well for internal confirmation if the market was to move a little higher. All right, let's go back to the slides. And different way to look at trade location. Okay, go ahead, Jim.
Okay. Now, most people, when I talk about trade location, and if you look at the first example, I was talking, your trades were at the high and the low of the early morning containment range. Well, people think that's all I mean by trade location. And that's not necessarily the case. When I talk about trade location, I am always talking about some place I can do a trade and I know where I want to put my stop. Remember, I want to control my risk first. I can control risk. I cannot control return. I want to work with that area I can control. Now, here's a case where I've shown the balance. You have a 3-period balance with an inside bar. And you'll see that's in the, about the center of the previous day's range. So most people would think, well, to buy it or sell it there, well, that doesn't make a lot of sense because that's bad trade location. No, it's not. Because when I break out to the downside in D period, I came out of balance. I had a 3-period balance. The 2 best trading opportunities you'll ever find are when you have an excess high or low or when a market comes out of balance. And that is for any time frame, whether it be yearly time frame, weekly time frame, short time frame. The 2 most significant things you'll ever deal with are excess and balance.
Jim, can I interject something right here and ask you a question?
Sure.
Totally understand coming out of balance, and I think most people do understand coming out of balance, but can you talk about the context of the different types of trades of, for instance, Jim, a lot of times we'll have a market that just consolidates for, say, 3 entire days. That's a 3-day balance, correct?
Yes.
Right? Okay, here, however, in your picture, you have a 3-period balance, which is only 90 minutes. Do you look at that as maybe a smaller trade because it's only 3 periods as opposed to days, or does that not matter?
It's probably, yeah, the bigger the balance, You talk about days, weeks, months. The bigger the balance, the greater the odds that when it comes out of balance, that the ensuing auction will be very dynamic.
Mm-hmm. Okay.
So yes, so if I balance for 3 months, probably going to be a really big trade.
Right. Okay. Good.
But sometimes you'll start out of balance something small like this, and it will continue, and you kind of monitor for continuation. But one of the things too, I'm always looking about market confidence. So when I look, and this balance is taking place in the middle of the previous day's range. Now, when I have an inside day developing, then I'm looking for the opportunity that's probably going to be a small opportunity. Mm-hmm. If I was out of balance and came back into the previous day's range, now the opportunity may be much larger. I'm out of balance and I come back in, it may be a bigger trade. But when I'm within the previous day's range, my mindset is I'm looking for shorter term, smaller trades. So on the trade we're looking at right here, three period balance, and I'm going to take the trade when D period comes out of the inside bar in C period and coincides with the others. I'm going to take that trade. My stop would then be placed someplace back above the D period high. Not way above, but just a little bit above the D period
Right, just
high.
back inside the balance area, because you're thinking at that point, if this trade is going to work, we shouldn't go back and re-enter the balance area.
That is correct. That is correct.
Yep.
That makes total
Yeah.
sense.
We talk about that all the time, guys. You can relate what Jim is saying to day trades that Brad does. For instance, on a first 5-minute high, if there's a big bar, we always say you shouldn't come back in more than halfway, or, this can easily be related to a lot of the normal candlestick TNA stuff, that we talk about all the time, where we have, let's say you have big up bar, 2 dojis, you're a buyer over, you shouldn't come back into that range, etc. So this is great stuff.
And the other key thing, Jim, is a lot of people, I don't think they know how to differentiate between, going for smaller opportunities versus always swinging for the fences.
Yep.
Because
right, that's why I asked what I asked about how do you look at, you look at a 3-day balance, and that should be a much larger move.
Exactly.
But this is more of a smaller intraday move if I'm coming out of a 3-period balance,
Yeah, that's good stuff.
Very good.
Yep. And it's very important because, but it's the part of the mindset that you have. You always know where a market's going to open. You've got the electronic trade, and you know where the market's going to open. So before the first gong ever goes off, you know if you're in balance or out of balance. That helps me get the mindset of what I'm looking for. It helps me guide my trade. So, for example, when this trade breaks out to the downside in D period, I want to go with the trade, but I also will probably put an order in ahead of time to take my profit someplace around the previous day's low. Mm-hmm. Now, what happens to some traders that say, what if it was a big trade? Well, I would really feel stupid if, I got out of this trade and it really broke to the downside. Once that thought goes through your mind, you have very little chance of being profitable in trading. When I am trading well, I'm just going with the odds. Everything's odds to me.
Yep. When
I break out of this trade, I already know if I get down there, I've got an order in a few ticks above the low. I'm coming out of the trade. I'm not going to carry it home with me. I'm not going to go worrying about it. I've gotten very good at not carrying stuff forward. When I'm trading poorly, I start to say, I had a bad trade this morning. Boy, if this really broke, I could, this might make me even. Boy, now I want this to break. I need this to break. Once those thoughts go through your mind, you haven't a single ounce of objectivity left in your mind. It just doesn't, it's not there. And the chances are very slim that you're going to be profitable. The other thing that I do is I talk about monitoring for continuation. So when this trade breaks, monitor for continuation, I'm just automatically looking for the low down there, a couple ticks above it. And that's all I expect out of the trade. Guess what? If it goes lower, so what? So I missed the trade. Maybe I can get back into the trade. When you start thinking about what could have been, it's pretty difficult it's pretty difficult to be successful in trading. But the main thing here is that trade still took place within the center of the previous day's range, and I still call it good trade location. And I call it good trade location because I had a place, I knew where to put my stop. I had an idea what the trade should be. I can think of risk reward, etc. The other thing, it is rare that I will let a stop take me out of a trade. If you find that more than about 5% of your trades are coming out of earned stops, you need to rethink everything you're doing. You should come out of the trade when the market isn't showing you continuation. Don't pray. Don't overweight it. When it's not giving you that, come out of the trade.
Yeah, so as soon as you see it's not working, Jim, you're out. You don't even wait for the stop to be hit.
Absolutely not. Because what happens, once we start waiting for the stops to be hit, now we can say things like, well, they came and got me. They got me. Those son of a guns.
Right.
Well, it's not them, it's you.
Right.
You're responsible for your trade.
Right.
And what a great feeling when you get control, when you know you have control of your trading, you start to get confidence. I get emails all the time. Have you ever written an article on confidence? How do you gain confidence? Well, one, it's a great topic. You gain confidence by doing your preparation ahead of time. And you heard some of that this morning. You heard how I'm prepared before the market starts to open. I'm not, what am I going to do? What am I going to do? You know, I've got some idea ahead of time. You heard that, and I think about that. And then I say, am I in balance or out of balance? Am I looking for big trades or little trades? So being prepared is very important. Understanding what went on ahead of time is part of being prepared, but that also gives you some idea of what could happen in the marketplace. Once you do this, once you get prepared, once you understand how markets function, once you understand do we have long time frame money or this is mostly short-term money in this market, and that's a major subject. Who's controlling? Is it short-term or long-term? That takes a long time to start to really understand and appreciate, but extremely important. Short-term traders act much differently than long-term traders. But once you start to do that thing, once you get confidence in the market, all of a sudden you start to feel good, you start to be objective, and the fear and the stress starts to diminish considerably.
Right.
In the marketplace. And that's what it's about. If you're living under constant stress or, you move your stop, you put it here, well, I don't know what's going to happen. Well, guess what? If you don't have a pretty good idea, you don't have trade location, don't do the trade. Most people overtrade. Okay. So and you can see once the market came back, it settled down. Now, what happened, what happens later, you may get other trades out of there. You've got the DEF period. Notice how that's coming together one more time. It's coming together one more time.
No.
And that is the same market. Now, one of the things that's important here, notice the well, no, it's not. That's something else. Anyhow, I'm going to stop right there. Let me put up the last slide, and then let me take some questions for a few minutes, okay?
Okay. You want to go to the last slide?
Last slide.
Yes,
Okay.
please.
Okay.
All right.
Okay, the last slide is a 3-day seminar. This is really what people that are serious, doing a 3-day live market seminar in Chicago, April 28th to 30th. You can go to our jdaltontrading.com, and under events, you will see the description of the seminar. There's our telephone number if you want to call and talk to my equal partner, Julia Stewart. But we would love to have you at this seminar. It's in DePaul University downtown in the Loop in Chicago.
Yes, I will more than likely be there myself, so it'll be nice to meet some Shadow Trader people there. And remember that the Shadow Trader weekend update, starting from a couple of weeks ago, if you scroll down to the bottom, there's a section there called What's New, and there's details on this event there. and also links that you can click on to get, you know, a discount for Shadow Trader listeners and to register early before the 31st for Jim's event.
Peter, thank you very much. And incidentally, Shadow Trader folks have been very good to us, and they've been some fairly knowledgeable people in these events.
That's great.
Okay, let me take a few questions.
Okay, so Jim, first question here, and some of this was already, you know, kind of addressed here, but you could maybe go back to it. It's a little bit on the psychology. This is, let's see, who's this gentleman? Uncle Fungus, I'll call him. That's kind of a strange email address. He says, I know that I am supposed to see a trade setup and just take it. And I do that sometimes. However, I have been hesitating the last few months. The negative reinforcement from this is the fact that the majority of these trades didn't work. Can you please help?
Well, I don't want to offend anybody, but I cringe at the word setup. Because I don't know what that word is, and I know a lot of people talk about and sell setups, and this is it. I just don't think markets work that way. Where I think the good trades come in is understanding how markets work and how markets function. You saw what we did this morning. We talked about several places in order to do trades in there. And, you know, if you do your work, you identify the levels, containment levels. I said the two most important things are excess and balance. You get those levels and you say, you know, how would you know if a trade's going to work or not? You don't know if a trade's going to work, but you can, for example, if a market's got low confidence, in other words, it's back and forth, there's not good tempo, then the confidence is low. And that's a difficult market to trade in because you have to be right very quickly. The other thing that you want to be aware of, what is the overall trend? What is the overall trend? And you have the long-term trend, then you have the daily trend. But if you have a daily trend, if you trade against a daily trend, you have to be right immediately. A lot of people cannot help fading a trend day.
Yeah.
And you know, we had one the other day. The market one time frame higher all day long. By one time frame, I mean the first period of the second period did not take out the low of the first period. The third period did not take out the low of the second period. It one time frame higher all day long. When you fade or go against one time framing, it's suicide.
Yeah.
You know, you should be on a trend day up. You should be buying breaks, not selling rallies.
That's right. Jim, explain one time framing for the people that don't know what that means exactly.
Pardon me?
Explain one time framing for the folks who may not know what that means.
That's what I was saying. When the market is one time framing, the low, let's say it's one time framing up, the low of the second bar will not take out the low of the first bar. The low of the third bar will not take out the low of the second bar. The low of the fourth bar will not take out the low of the third bar. Mm-hmm. It's one time framing higher all day long.
Now, Jim.
Now, sometimes you get an inside bar, but that doesn't stop it. That may bring it into balance, but it doesn't stop it.
And Jim, that's exactly what we saw on Wednesday. I mean, it one time framed higher pretty much all the way until
L period or
like M or N period. I mean, we started B, so I don't know what you start at.
Yeah, he does too as well. Yeah.
Yeah. Okay. Yeah. I mean, so Wednesday was
the very end.
Yeah. Yep. So Wednesday
and
was.
I have all kinds of clients, or not clients, but people, you know, trying to contact me and complaining. Well, I don't know why this trade why it didn't work. And I said, why didn't it work? What goes through people's mind? They say, well, you know, if it was, you know, if it's 10 points higher, it's got to be a great sale. Why? Right. I mean, that's the thinking. And what happens when you do a trade like that? Something was at 10 in the morning and now it's at 15, and you sell it instantaneously. You feel very good because you think you just did this one great trade. That good feeling usually lasts for seconds, and all of a sudden it's going with you. But it's intuitively you think that selling something at 15 that was 10 an hour ago has got to be a good trade.
Yep.
You know, sometimes it's the worst trade because momentum is there.
Yeah, and then it goes to 20.
That's right, and watch markets closely. Very seldom do they turn around. We've had some lately that have turned around, but it's not very often. And when they do turn around, yesterday's market, if you think about yesterday, you're trading the S&Ps. Confidence was very low in the morning, and then the market finally started to the upside. But when they do turn around, they will normally turn around at some visual reference. And that's what it did yesterday. It failed at a visual reference to the tick. So even when it goes to the tick, what that tells me is that I've got short-term money in there. And I know that short-term money, if they start to take it back, they'll squeeze them right in through the close. And, and that's exactly what they did. Longer-term money doesn't turn around that quickly. Short-term money can be very, very emotional. Now, let me go back for a second and talk about the one time frame one more time. So you have a trend day up, and I think, Brad, what you said the other day on Wednesday, it didn't stop one time frame until late in the day.
Yes.
Normally, a trend day will stop one time framing one time. Sometimes it's midday, sometimes it's near the end of the day. That stopping the one time framing one time will very often trap traders. They'll get short at exactly the wrong time. When that thing is, you're getting an inventory correction, it will back off, and it will look pretty vicious, because you get a liquidation when they adjust. If the market's going up and you get an inventory adjustment, it'll look pretty wild there for a couple of minutes, because it's a pretty fast drop, and you think, oh boy, I got to get short this market, because you know how low it was, and you get short, and that's the low for the afternoon, and away it goes. Understand it. Normally on a trend day, you'll get a one time, it will stop one time frame. That allows the short-term inventory to get in a little bounce, and then you normally go again. Mm-hmm. Don't get trapped. If you understand it's a trend day, don't get trapped by the one short-term inventory correction.
That's right. And I was just going to say, Jim, what's also important is that in subsequent days after that, remember that pullback low is a reference point on a trending day.
Absolutely, because again, and why? It's a point of change. So if the market goes up today and it pulls back to 1508 this afternoon, then it rallies again and closes at 1513. I'm just picking numbers out of the air. Mm-hmm. What you're looking for is change. So if the market tomorrow just pulls back to the afternoon pullback low from today, there's no real change in the market. You got a little inventory correction, but there's no real change. And the market's trading is about change. That's where the opportunity takes place. There's no change. There's no opportunity. Let me take this, and we'll take a couple more questions, but let me take and look at this, the S&Ps again. We talked early on about the market being short. You got into yesterday's range. You came back down, and on this last pullback, I don't know if anybody was watching it, but you went basically to the opening. On the last pullback, I think you went basically to the opening, and then they came and they got the shorts again. But remember, you've got that very prominent fairest price level up there. I don't know if we get there, but, we're now the second time into yesterday's range. I don't think it's a high-confidence market. And what I said this morning, when I wrote this morning, I said, you don't have to be in every market. I've watched the volatility. It's been a very tough market in here.
Yeah.
But
Now, Jim,
all I know is that it's you do have to keep your eye on that point of control. The next upside reference when I shut up will be the overnight high. That's what it's gunning for right now. The overnight high.
13.5. Yeah. 15.
Peter, let's take a couple more questions and then we'll call it.
Yeah. Okay. So it's good that you just talked about the the low confidence, high confidence, because the next question is actually about the volatility from Justin P. from New York, who says, you do extended periods of high volatility or low volatility impact at all how you interpret the market profile? If so, how would you adjust your style, et cetera?
Well, I don't know if I can answer the question directly, but I will give that a shot. One of the things I want to address first, a lot of times advice people give is, well, figure out what you do best and then concentrate on that when you trade the markets. And it sounds so intuitively correct and it sounds so intelligent. I think it's terrible advice. And the reason for that is that if you're going to be a long-term professional trader, not long-term in trade, but going to exist for a long period of time, you have to adjust to the market. The market doesn't adjust to you. If you have the discipline that you only trade when it's your kind of market, that's okay. Most people don't have that. They want to be in the market all the time. If you're going to be in the market all the time, then you have to adjust to the market if you're going to survive over a long period of time. One of the adjustments is being able to recognize when volatility is high and when volatility is low. Right along with that is understanding, is the market being driven by the long time frame, or is it being driven by mostly short-term traders? That is probably more important than anything else, because the short-term traders, they're not going to take the markets to expensive, long-lasting lows. They may move it big one day up and one day down. But if you're talking about something that's sustained over a period of time, that's not going to be where it's going to come from. So, when you know that it's the short-term traders, and that's generally who you have in the market, then you find the markets go to very visual levels. They go to previous highs and lows. They go to opens. They go to half back. They go unchanged. Unchanged is another huge short-term trading element. When the long time frame is in the market, they don't go to exact references. Most of the time, the long frame time frames in the market, they don't even know what those references are, nor do they care. Mm-hmm. So what happens if you don't understand who's in this market? And that takes a little while. You spend your lifetime, understanding that. I think I do a pretty good job of it, but I'm not always right. But that has a whole lot of difference between the types of trades you engage in. When it's short-term trading, it's like yesterday. I knew it was short-term trading. I knew by the volume. I knew by the tempo. It was very slow. And I knew by the halting nature of it. I knew by the poor low yesterday morning. And then it confirmed, because it went right up exactly to a previous very visual high, to a tick. And so that's a pretty good sign of who's in the market. And then I know that those people, they panic. They can panic. And they run the market one way and the other. Mm-hmm. Long-term money doesn't panic like that. They don't get in and out that fast. They're in it for a much bigger move. They're in it for a longer period of time. So this idea of the volatility, it's equally important to understand who's controlling the market. And generally, more volatility comes with the shorter-term traders, because they're antsier and they're more emotional, and they switch on the drop of a hat very quickly. Any news announcement, and they rally the market. Any news announcement, they crater the market. Right. So that'll help you tremendously, knowing who's in the market. Anyhow, it's not an easy question. They say you'll spend your lifetime working on that issue. But I see, as we're doing this, we are one tick short of either that or one tick short or exact from the overnight high. Remember one of the things we said earlier, once you re-enter, you look below the overnight low. Once you re-enter the overnight low, the destination trade becomes the opposite extreme, which would be the overnight high. Mm-hmm. Does it have to happen? No, but it's something that if you learn what to look at and you observe over a period of time, you will start to appreciate more and more of some of the things that I talk about. Again, remember, I am not a profile trader. I am a trader, and I use the profile to organize the market's continuous two-way auction process. Having that data organized helps me with the interpretation. For example, having the data organized helped me understand the fairest price to do business yesterday. It helped me understand that the market was probably short coming into today. So it helps me, but I'm not a profile trader. I'm a trader first, and that means I'm very much aware of the dollar index and what effect that can have. I don't trade the dollar index, but I'm aware to know that it's having an effect on the markets. We do not trade in a vacuum. Anyhow, Peter, let me take one more question, and then I'll say thank you.
All right. I'm going through these here. You may have touched on this, but I know it's kind of it is definitely one of the pieces of your work you talk about sometimes. A gentleman was asking from Dallas, how much weight do you put on the overnight profile, and do you ever make any trades in the pre-market or before the bell?
It's a good question. First of all, it's a complicated question. If you are trading overnight, using it to trade overnight, now not using it to trade the pit for the pit session, but trading overnight, you will find that the highs and lows overnight are important, and the market will just kind of stall there, and then it will rotate the other way. You will find that the shape of the profile is not nearly as relevant as it is during the day, and the part of that is caused by the fact we go for hours and hours and hours, and the market does nothing. You know, early in the evening, sometimes just before and after the Asian session, the market moves sideways. There's nothing going on, but the profile gets fat, but there's no real volume associated with it. So basically, all I use the overnight market for is to understand if the high and the low of the overnight market, that, and I compare that to the previous day's settle. That tells me if the overnight inventory is long or short. So I want to know the overnight high or low, that's the reference. I want to know if the overnight inventory is long or short. I measure the long and short component from the previous day's settle. For example, almost 100% of the overnight inventory coming in today was short. Now, I actually look that up, and I consider that a negative. As you can see, this market is very thin on the S&Ps right now. They're continuing to squeeze the shorts from overnight and from yesterday, and now we're looking above the overnight high. Mm-hmm. So I do that, and I will sometimes use the overnight market to enter a trade. For example, Peter asked about the pullback low. It's not uncommon for me to, if I want to be in a market and I get a chance in the overnight market to buy a pullback low or a rally high if the trend day was up or down, I may use the overnight market in order to re-enter a market that I wanted to enter in the first place. But I generally don't. I have a tendency to use the overnight market to take profit. For example, if I came in short and the market breaks too much overnight, I will use that more often to exit a trade than I will to enter a trade. Usually, if I do enter a trade in the overnight markets, it will generally be because I'm going to buy puts or calls rather than futures. I hate to have futures overnight. I find they don't sit too well, and there's crazy stuff that can happen. But sometimes if I think, for example, I want to be long a market and the market breaks overnight, I may buy calls.
Right, to
but
sort of hedge
generally
that off.
Generally speaking, I use it for is the inventory long or short, and what is the high and the low of the overnight inventory as my references.
That's excellent.
Okay?
All right, Jim.
Peter, I want to thank you very much, and I do hope you're able to join us in Chicago, and I hope that